Management. Here's your closing bell, final one of the week here on Yahoo Finance.
There's your closing bell on Wall Street. The sell-off started on Wednesday with the words of Jerome Powell, a 50-point hike. They continued on Thursday with an absolute beating, the Dow's worst day in 3 months. And yes, here is how we finish out the week. Off the lows, but still a pretty rough close to the week with the Dow dropping 280 plus points. The S&P down more than 1%. The NASDAQ also dropping about 1%. A broad-based sell-off to end this week. Let's talk more about it with Ahmed Riesgo, Insigneo Chief Investment Officer, and Michael Kushma, Morgan Stanley Investment Management, CIO of Broad Market Fixed Income. Nice to see you both. Ahmed, let's start with you. What do you make of the last 3 days collectively coming off the words of the Fed chair?
Yeah, we were always a bit skeptical of the rally. We saw it being driven mostly by technical factors like liquidity and positioning. Our view has been that the S&P is going to end the year somewhere between 3,400 and 3,700. And that's because we are projecting a recession, a mild recession, to begin next year. I'm not really sure that a lot of the market drawdown was really due to Powell's comments. I think more than anything, the ECB has been the sort of hawkish surprise that has really driven rates higher in Europe. And I think that's what's putting pressure here on markets, not so much the Fed. The Fed really didn't come out that far from where they had been or where expectations were.
Michael, I want to stick with the Fed here and get your reaction to what Powell was saying the other day, and especially with regard to recession talk, because I was listening to Powell with great contortions try to explain how it might be possible conceivably to end up with a soft landing next year. Is that a possibility?
It's certainly a possibility. I wouldn't say a high probability, but it is possible. The Fed has emphasized that the unemployment rate is too low, the labor markets are too tight to be consistent with the 2% inflation target medium term. So they have to loosen that up by keeping monetary conditions restrictive for some unknown period of time, meaning that we don't know how long it'll take, but we'll keep them there until we get evidence that that is loosening up. On the other hand, I don't think they can predict or forecast a major recession. Otherwise, their policy is too tight. So I think there's a consistency there that weakness in the economy, below trend growth, gently rising inflation, gently falling in inflation over time, gently rising unemployment, I should say. But still, the challenge is that medium term, they did raise their forecast for inflation, as did the ECB, as did most central banks this week. They were more pessimistic about where inflation is going to be in 2 years' time.
Ahmed, are you in line with that new projection from the Fed?
Look, we're always looking forward in the sense that you don't want to really pay attention to what the Fed is saying today. You want to project what they're going to be doing 3, 6, 9 months down the line. We are a bit more confident that inflation is going to be coming down harder. So we were a little bit surprised by the upward revisions with the inflation numbers coming out of the Fed. But listen, the Fed itself, if you take a look at the Fed's communique, they actually had a whole section on the uncertainty over their outlook. So the Fed themselves are telling you that their projections are subject to a higher degree of uncertainty than usual.
And Michael, just want to get your reaction to what's been going on with the dollar, also other currencies as well. One thing I noticed Wednesday was we didn't get a lot of reaction out of the dollar, even though stocks in a lot of risk markets sold off after Powell's statements and after the FOMC announcement was made. We didn't really see currencies fluctuate as much. The dollar has been a big driver, I would say, wagging the dog of a lot of these risk markets that we watch around the world. How are you viewing the U.S. dollar's outsized influence on markets, or maybe it's not outsized anymore?
It's outsized maybe with regard to certain countries and currencies, but not across the board. I think the ECB, as was just mentioned, is out hawking most every other central bank in the world. They were clearly in the vanguard, out front in terms of raising inflation projections and emphasizing that interest rates will be continuing to rise to levels which no one thought possible probably 3 or 4 months ago. On the other hand, they're probably about 6 months behind the Fed. I mean, 6 months ago, no one was predicting the Fed would get to 5%, well, almost no one. And no one was predicting the ECB would go over 3 next year. And now they are. And it's still trending higher. So the euro, I think, is getting increasingly well behaved because it is taking over the mantra of the most hawkish central bank with the biggest inflation problem. And yet the economic situation doesn't seem to be deteriorating that much in Europe. But against other currencies, the dollar is still holding its own. But the Fed, despite falling inflation, is still holding firm to this view that they have to keep raising rates to over 5% next year.
All right, Ahmed, we won't see you before the end of the year, but I know you mentioned 34 and 3,700 for a year-end target, so no Santa's showing up. What about 2023? What are you projecting, and advice to investors?
Yeah, so we're projecting a rather, I guess, flattish market in the sense that definitely not like the returns that we've seen the previous year or in previous years. Right now, we're expecting somewhere between 41 and 4,300 as a year-end target for 2023. What we are advising our clients, though, is to start moving money outside of U.S. equity markets. We find the picture outside of the U.S. much more interesting. We think there's actually a potential right tail risk in terms of upside growth surprises coming in from China. So far, China, and it's not something that's being spoken about much here in the U.S., but China has done a 180 in terms of their COVID policy, stimulus, the amount of liquidity that they're injecting into the economic system, even what they're doing in the technology sector and with the U.S. listings. They've really done a 180. I really think that this year you have to sort of believe them that they are going to try to get to that 5% growth target. And if they are, China will be a source of upside growth risk for the global economy for next year. So we're focusing a lot on the emerging markets. Certain markets there are quite attractive. We're also waiting for Europe to finally get some kind of resolution with their energy crisis and with the war. We think once they do, we think actually the growth prospects are going to be better in Europe than they are in the United States, and the market prospects are going to be better as well because European assets are right now trading at historical, unprecedented discount levels to U.S. equities.
All right, some international opportunity ahead. Ahmed Riesgo and Michael Kushma, thanks so much for being here. Won't see us, so Merry Christmas to both of you. Have a good weekend.